What is the interest you get? 30 lakh into 8%. 30 lakh into 8% it is 24 lakh. 50% is the tax rate. The company wanted to expand its business, so they are adding new capital to the capital structure, that is the debenture. Whenever the balance sheet is given, so what you all have to do? You all have to consider only the relevant information which is required for the WACC computation. Hello everybody, I am your Divya ma'am, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. I welcome you all for the session 9 on your Unit 1 Cost of Capital. The previous 8 sessions we have discussed about the calculation of specific cost. In today's class, we shall take up the problems on WACC, that is your 15 marks problem. Moving forward, problem number 1. The following is the capital structure of SEAL Limited. Equity shares 20,000 shares of rupees 100 each. It is 20 lakh. 20 lakh is the value. What is that value? Book value. So 20 lakh worth share have been issued at 100 rupees each, 20,000 shares. So 20,000 shares, 100 rupees is what? Net proceeds. Next, 10% preference shares of rupees 100 each, rupees 8 lakh is given. So 10% preference shares of rupees 10 each. So number of years is not given. So it is irredeemable preference shares. Further, 12% debenture of rupees 12 lakh. So 12% debenture of rupees 12 lakh. The market price of the company is 110. So market price with respect to what? With respect to equity shares. It is expected to the dividend of rupees 10 per share would be declared after 1 year. The dividend growth rate is 6%. So your preference share, your debenture, both are irredeemable debenture, irredeemable preference shares. So if the company's tax rate is 50%, compute the WACC. First condition, tax rate is given, so it is after tax debenture problem. Next, assuming in order to finance an expansion plan, the company is intended to borrow a fund of 20 lakh. So in order to expand the business, the company have borrowed 20 lakh with interest rate of 14%. So this financing decision is expected to increase from 10 rupees to dividend 12 rupees per share, and the 105 is the market price. So there's a change in the market price as well as the dividend issued once the company is planned to expand. So two condition, two WACC table you all need to compute. So now let us consider the following information of the first condition and then solve the second condition and computation of new WACC, that is adding an extension of 20 lakh debenture at 14%. Moving forward, so let us calculate the cost of equity first. So in order to compute the WACC table, specific cost is essential. So we are calculating specific cost. Cost of equity shares, what is given? 100 rupees is the net proceeds given. Further, they have given the market price, they have given the dividend, they have given the dividend and the growth rate. So what is given in the question? Dividend is 10 per share. Since the market price is given 110, we are taking 110 market price, and 0.06 is the growth rate, 6%. So if you convert, you get the answer as 15.09%. Next, we need to calculate the debenture, that is your preference shares calculation. 10% preference shares of rupees 100 each. Since it's a irredeemable preference share, formula would be preferential dividend divided by net proceeds. So dividend is 10 rupees divided by 100. So 10 divided by 100, it is 10%. Next, it is after tax problem, 1 minus tax rate divided by net proceeds. Since it's a after tax, so interest 1 minus tax divided by net proceeds. So what is interest? 12% on 12 lakh. So it is 1 lakh 40 4,000 is the interest. So 1 minus 0.50, it is 0.5. Next, divided by 12 lakh. So 12 lakh is the net proceeds. So if you calculate, it will be 6%. I have calculated all the specific cost in the 8 sessions, how to calculate the specific cost based on the formula. So before this, coming to WACC table formula, WACC problems, kindly go back to all the 8 sessions and calculate the specific cost before calculating WACC. Moving forward, now we have calculated equity shares, preference shares and the debenture calculation. So with the help of this, now we need to calculate the WACC. What is WACC stand for? Weighted average cost of capital. Moving forward, computation of WACC. So what is the format of WACC? Sources of finance. How many sources of finance we had in the question? 3 sources: equity, preference shares and debenture. Equity, preference shares and debenture. What is the book value given in the question? 20 lakh, 12 lakh, 8 lakh. So we have taken that 20 lakh, 12 lakh and 8 lakh. The total of that will be the total book value. And the next column is what? Weight. How do you calculate the weight? Book value divided by total book value. So that is 20 lakh divided by 40 lakh, 0.5. Similarly, 12 lakh divided by 40 lakh, 0.3, 0.2. Now, specific cost we have calculated. So, this calculation we have taken here in the specific cost. And the next column is what? Weighted average cost. So, how do you get weighted average cost? Specific cost into weight. Weight into specific cost. If you do it, you will get your weighted average cost. The total of it will be the overall cost of capital. So, this is the calculation of condition A, where the corporate tax was 50% and we have calculated. Further, the company wanted to expand its business, so they have added an additional capital to the capital structure. That is what is 20 lakh. 14% interest rate. Since there is a changes in the capital structure, there will be always changes in the dividend that is issued for the equity shareholders. So that is, there is an increase of 12 per share and market price is 105. So you need to calculate again the specific cost for the calculation of cost of debt and the calculation of your equity shares. Moving forward, calculation of cost of debt, interest into 1 minus tax rate divided by net proceeds. Interest 20 lakh into 14%, it is 2,80,000. 1 minus tax rate divided by net proceeds is 20 lakh. The answer you get is 7%. Next, we need to calculate the cost of equity. As I have mentioned, y'all, dividend is 12 rupees. Net proceeds is, since we have changes in the net proceeds, that is your market price given in the question. So, market price we are considering 105. Growth rate is similar. So, 12 divided by 105 plus 0.06. If you multiply, you will get the answer 70.43 is the answer. Now, calculate the computation of new WACC. Computation of new WACC. 12% debenture, 10% preference shares, equity share capital 14%. Everything remains the same. The only addition here is 20%, 14% of 20 lakh debenture is added to the new WACC table. So, 14% debenture of 20 lakh. Now, the total book value changes. Weight you will calculate. Specific cost you will calculate. Specific cost here it changes. Equity capital it changes. So, both the calculation you will do, you will multiply with the weight into specific cost. Then you will get your weighted average cost and the answer you get is overall cost of capital is 10.56%. So, this is computation of new WACC. Next problem. Problem number 2. The following is the capital structure of a company. Determine weighted average cost of capital, equity shares, debenture, preference shares. Following information is given. So, external financing information. Equity shares, selling price is 120 per share. The expected growth rate is 7%. The dividend is 11 per share. Expenses of issuing is rupees 8. So, let's calculate that. Next 15 years, 14% debenture of rupees 1000 each, face value, redeemable at 5% premium, sold at par, 3% flotation cost. It is which debenture? It is redeemable debenture. Next we have 7 years, 12% preference shares. Again it is a redeemable preference share. 7 years, 12% preference shares of rupees 100 each, sold at par and redeemed at a 5% premium. 3% is the flotation cost. Tax rate is 35%. Next you need to calculate the WACC. Now let's calculate equity shares. What is given with respect to equity shares? 120 is the net proceeds. Market price is not given. Growth rate is how much? 7%. 7%, it is 0.07 is the growth rate. Now, what is the dividend? That is 11 rupees is the dividend per share. And what is the issuing cost? 8 rupees is the issuing cost. 120 minus 8, it will be how much? It will be 112. 112 is the net proceeds. 11 divided by 112, growth rate, if you substitute, you will get the answer as 16.8%. Moving forward, next with respect to debenture, number of years is given. 15 years, 14% on 1000, it will be 140 rupees is the interest, and they have given the 5% premium. So when you are redeeming at 5% premium. That means 1000 into 5%, it is 1050. That is the redeemable value, maturity value. Next, it is issued at a par, 3% flotation cost. 100 into 3%, it is 30 rupees. 970 will be the net proceeds. So what is the formula? Interest 1 minus tax rate plus maturity price minus net proceeds divided by number of years, whole divided by maturity price, plus net proceeds divided by 2. So that is the formula. With respect to that, we have substituted all the values. Interest 1 minus tax rate is 35%, remaining 0.65 is the tax rate. We have substituted all the values as per the given information. The cost of debt you get is 9.5%. Similarly, we'll calculate the specific cost for the preference shares. Number of years is how much? 7 years. 12% preference shares, that is 12 rupees is the dividend, sold at par but redeemed at 5% premium. So 100 into 5, it is 105 is the redeemable value, maturity price. 3% is the flotation cost. 100 into 3%, 3 rupees. So 97 will be the net proceeds. 12 rupees, 105, 98. That is your number of years is given. All the values, if you substitute, the answer you get is 12.8% is the answer. So now we have calculated all the specific costs. Now let us compute the WACC table. Sources of finance, equity, debenture and preference. Book value is given in the question. 20 lakh, 12 lakh and 8 lakh. 20 lakh, 12 lakh and 8 lakh. Total value is 40 lakh. Weight, if you divide the book value of individual with the total value, you will get your weight. Specific cost as we have calculated. If you multiply that, we will get your weighted average cost. The summation of this will be the 13.82%. That is your overall cost of capital. So this is your second problem where I have taken up the answers and the problem based on redeemable preference share, redeemable debentures and your corporate tax rate. So this is how you need to calculate. Moving forward, next problem number 3. Z company has the following capital structure of equity share, 20,000 shares of rupees 20 each. It is how much? 4 lakh. 6% preference shares of 10 lakh. 8% debentures of rupees 100 each, 30 lakh. The equity share of the company sold at 20 per share. If the expected dividend rate is 2 per share, which will grow at 7% forever. Assume the tax rate 50%. You all need to calculate the weighted average cost of capital based on existing capital structure and compute the new WACC If the company raises 10% debenture of 20 lakh, this would reverse in increasing the expected dividend from 3 per share. The growth rate remains unchanged and the market price will be 15 per share. So this is similar to the problem number 1 we have solved. So whenever new WACC computation is given, redeemable will not be given. So whenever 2 WACC calculation will be given, redeemable problems will not be given. Directly you can solve the problems. Now let us take up the equity shares first. Equity shares, 20,000 shares of rupees 20 each. What is the 20 each? 20 each is the net proceeds. 2 rupees 20 each, growth rate if you take up, calculate 17% answer you get. Next, preference shares, preferential dividend divided by net proceeds. What is the preferential dividend? 6% on 10 lakh, it is 60,000. Net proceeds is 10 lakh, 6% is the cost of preference. Next, cost of debenture, interest and the tax rate is given. Interest into 1 minus tax rate. Tax rate is how much? Tax rate is not given in the question. So directly you can take up the problem. What is the interest you get? 30 lakh into 8%. 30 lakh into 8%, it is 24 lakh. 50% is the tax rate. How much is the tax rate? 50% is the tax rate. What are the information given? 8% debenture of rupees 100 each, 30 lakhs. So 8 into 100, it is 8 rupees. You can also take like that, or you can also take 8% on 30 lakhs. So 30 lakh on 8% is also correct. 8% on 100 rupees is also correct. So both the way, if you solve the answer, you will get the similar answer itself. So 2 lakh 40, 1 minus tax rate 0.50. The net proceeds is 30 lakh. Since we are taking 30 lakh only, whole amount, net proceeds will be 30 lakh. If we have taken 100 rupees for the calculation, interest rate will be 8 and the net proceeds will be 100. Since we are taking on 30 lakh, so 30 lakh will be the net proceeds and your interest calculation also will be on the net proceeds. So if you similarly calculate, 4% is the cost of debenture. Now calculation of WACC, equity capital, preference shares and debenture. 3 source of finance we are using: 4 lakh, 10 lakh and 30 lakhs. 40 lakh, 10 lakh and 30 lakh. The answer you get is 80 lakhs. So this is how you calculate weight, specific cost as we have got. Next we'll calculate the total of weighted average cost. You get is 10.75. Moving forward, now we are calculating new cost. The company wanted to expand its business, so they are adding new capital to the capital structure, that is the debenture. How many percent debenture? 20 lakh, 10% debenture. 20 lakh on 10%. So, and your equity calculation also changes from 2 rupees. They have increased the dividend to 3 rupees. From the share price 20 rupees, it has been declined to 15 rupees. So, 2 calculation you have to do: debenture and equity calculation. Cost of equity, dividend divided by net proceeds plus growth. Growth rate remains unchanged. Dividend is 3 rupees. 15 rupees is the net proceeds. If you calculate 27%, you'll get the answer. Next, interest divided by net proceeds, 1 minus tax rate. Interest 20 lakh into 10%. If you do it, 2 lakh will be the interest. Tax rate is 50% divided by 20 lakhs. You'll get the answer as 5%. You'll get the answer as how much? 5%. So 5% is the specific cost. Now we are adding the new capital structure. Rest everything is similar. The following table what we have solved is similar. Only the equity calculation percentage and your debenture changes, rest everything we are retaining the same as per the old WACC table, and we'll calculate the new WACC. When we add it, you'll get the overall cost of capital as 13.6%. So this is how you calculate the new WACC table. Moving forward, we have next problem and the last problem for today's class. A transport company is interested in measuring the overall cost of capital. You are being supplied the following information, the balance sheet. Whenever the balance sheet is given, so what you'll have to do, you'll have to consider only the relevant information which is required for the WACC computation. Only the relevant information. In this balance sheet, the relevant informations are debenture, preference shares, equity shares, retained earnings. When it comes to assets, no assets is required for us. So only the relevant information we are taking. Next, anticipated external financing information. So it is all a redeemable problem. 20 years, 8% debenture of rupees 2,500 face value, redeemable at 5% premium, sold at par, 2% flotation cost. So debentures information is this. Number of years is how much? 20 years. 8% debenture on 2,500. 2,500 is the net proceeds. And while redeeming, we are redeeming at a 5% premium. So 2,500 into 5%, that will be the maturity price, and sold at a par, 2%. So flotation cost is there. You need to deduct that 2,500 into 2% flotation cost in your net proceeds. Next, we have 10% preference shares of rupees 100 each. So 10 rupees will be the preferential dividend and the sale price is 100. Net proceeds will be 100. 2% flotation cost, 98 rupees will be the net proceeds. So preference shares calculation. Next, equity shares. Selling price is 115 per share. Flotation cost is 5 per share. Corporate tax is 55% and expected dividend is 5% per year. The expected dividend at the end of the current financial year is 11 rupees. Calculate the WACC. So compute the WACC. 11 rupees is the dividend and the growth rate is 5%. And next is your selling price 150. Net proceeds is 115 with the flotation cost. The 110 will be the net proceeds. Now let us calculate the answers. Now first we are calculating debenture. Cost of debenture is equal to interest into 1 minus tax rate plus maturity price minus net proceeds divided by number of years, whole divided by maturity price plus net proceeds divided by 2. So your interest is 2,500 into 8%, 200 is the interest. Corporate tax is 55%, that is 0.55. If you subtract with 1, the answer you get 1 minus 0.55, you will get the remaining tax rate. Maturity price, since we are issuing at a premium of 5%, 2,625 is the maturity price. 2,450 is the net proceeds since we are deducting the 50 rupees flotation cost. The answer, when we substitute, you will get the answer as 3.89%. Similarly, cost of preferential dividend divided by net proceeds. 10 is the dividend, 98 rupees is the net proceeds. The answer is 10.20%. Dividend is 11 rupees. The growth rate 110, as I have told you all. The net proceeds. Next, if you substitute the value, the answer you get is 15%. Computation of WACC. The following information what you all have from the balance sheet, we have taken that. All the values will be similar. Only here the specific cost changes. See, equity share capital and retained earnings is similar, as I have told you. Cost of equity is equal to cost of retained earnings. So equity is 15%. So we have taken this 15% retained earnings. Here only rest we have all information we have taken up from the question. If you multiply with the weight into specific cost, you will get a weighted average cost. The summation of this is weighted average cost of capital. So this is how you calculate. So these 4 problems, if you all solve for the examination, you can score 15 marks on this problem. So that's it, my dear students. Hope the 4 problems were very easy and understandable for you all. So smile is the biggest jewel you can wear, people. Keep smiling. Thank you.